Hello and welcome back to my channel. In our previous two videos, we have seen about the introductory part of accounting and finance. We have also seen about the basic accounting equation that relates asset with that of liability and owner equity. So the basic accounting equation was asset is equal to liability plus owner equity. That means the given asset of a company is financed by either creditors or the owners or shareholders. Therefore, the total asset is the sum of the liability, that is finance contributed from the creditors, and the owner equity, that is the finance contributed from the shareholders or the owners. In our second video, we tried to see about double entry accounting system. That means we have seen debit and credits. This video contains lesson 3, that is a continuation of our previous two videos. So in this lesson 3, we are going to see about the some examples or solved problems on the basic accounting equation, that is asset is equal to liability plus owner equity. So lesson 3 is all about revised exercises from lesson 1. So let's go to the first transaction. So here we are going to have some 11 or 12 transactions. So the first transaction is Mr. John invested a capital of 1,500,000 into a business established in the name of X company. So here the owner is Mr. John and the company is Z company. Therefore, Mr. John invested a capital of 1,500,000. Z company has initially zero cash, but since Mr. John invested 1,500,000 in cash, so we expect the cash of the company to increase by 1,500,000. And the other type of account that is going to increase is the capital of Z company is increased by the same amount, 1,500,000. So in any type of transaction, there should be at least two accounts that's going to be affected. In this case, cash and Z capital, or the capital of Z company, is affected since Mr. John invested a cash of 1,500,000. So cash of Z company increased by this amount. Also, since this is initial investment, the capital of Z company is increased by 1,500,000. So the basic accounting equation becomes, so this is a basic accounting equation: asset is equal to liability plus owner equity, liability plus owner equity. So in the case of asset, we have only cash that is increased by 1,500,000. So this is for transaction 1. From transaction 1, the type of asset that is increased is cash, and there is no liability. So we have only owner's capital. This owner capital that is increased by 1,500,000. Balance of cash after transaction 1 is 1,500,000. There is no liability here. The balance of the owner's capital after transaction 1 is 1,500,000. Therefore, the total asset is 1,500,000. The total asset means it's only the cash because we have only one asset. And the liability plus owner equity, liability is 0. 0 plus 1,500,000 is 1,500,000. 1,500,000. So the total asset is equal to liability plus owner equity. Now let's go to transaction 2. In the case of transaction 2, Z company acquired a building for 500,000. Now Z company purchased a building for 500,000 in cash. So since the purchase is made in cash, so we expect cash to decrease. Cash to decrease with 500,000. The other asset account that is going to increase is building. Building is increased by 500,000. Let's see how we can register this transaction too. Now we have this basic equation: asset is equal to liability plus owner equity. So here we have two assets here, cash and building. Liability, there is no liability here. In the case of owner equity, we have only owner's capital. So this shows the balance of cash after transaction 1. The balance of cash after transaction 1 was 1,500,000 from the previous registration. There was no building on transaction 1. There was no liability, but the owner's capital was 1,500,000. So during transaction 2, the company purchased a building with 500,000 in cash. So cash is decreased here. The cash decreased by 500,000. So the balance of cash after transaction 2 becomes 1 million. Now in transaction 2, we acquire a building. Which amounts 500,000. Therefore, the balance of building after transaction 2 is 500,000. Liability, there is no liability here, so the balance after transaction 2 remains the same. In transaction 2, there is no change in owner's capital. The balance after transaction 2 of the owner's capital is 1,500,000. Therefore, the total asset of Z company after transaction 2 is 1 million cash plus 500,000 building. It becomes 1,500,000. So after transaction 2, the total liability plus owner equity is 0 plus 1,500,000. That gives us 1,500,000. So they are balanced. Now let's go to transaction 3. In the case of transaction 3, Z company bought furniture for 150,000 in cash. For the purchase of furniture for 150,000 in cash, cash is decreased by 150,000. The new type of asset, that's furniture, is obtained in transaction 3, and furniture, the new asset, to have the value 150,000 or to have the price 150,000. So this transaction is given by this table. So here we have an asset is equal to liability plus owner equity. So the balance of cash after transaction 2 from previous transaction was 1 million. The balance of the building after transaction 2 was 500,000, and there was no furniture in transaction 2. There was no liability in transaction 2. So the owner's capital is the same, remains the same. There is no change on owner's capital. It is 1,500,000. This is the initial contribution by Mr. John. So during transaction 3, there was a purchase of furniture that have the value of 150,000. So we expect cash to decrease by this amount. Cash decreased by 150,000. Therefore, 1 million minus 150,000 will be 850,000. So 850,000 is the balance of cash after transaction 3. And here in transaction 3, there was no building, but there was furniture bought. Therefore, after transaction 3, the balance of furniture is 150,000 and the balance of building is 500,000. So here we don't have liability in transaction 3. There is no change in owner capital in transaction 3. So the balance of liability after transaction 3 remains the same. It is 0. There is no liability. And the balance of the owner's capital is still the same, 1,500,000. Therefore, the total asset of Z company after transaction 3 is 1,500,000. 850,000 plus 500,000 building plus 150,000 furniture gives us 1,500,000. The total liability plus owner equity is 0 liability plus 1,500,000 owner equity, which gives us 1,500,000. So they are balanced. Now let's go to the next transaction. That's transaction 4. In transaction 4, Z company purchased t-shirts from a manufacturer for 300,000 in cash. So here we expect also cash to decrease because there is a purchase of some t-shirts with a price of 300,000. So cash is decreased by 300,000. There is another asset account, we call it inventory. We are going to sell these t-shirts and obtain some revenue after some transactions. Therefore we register them as inventory, and the inventory is increased by 300,000. So the cash decreased by 300,000 and the inventory is increased by 300,000. Therefore there is no change in the total asset of the company. The only thing changed is the type of asset. So from cash to inventory. So this is the transaction 4. We have an asset here. Asset is equal to liability plus owner equity. So here our assets are increased from 1 to 4. We have cash as an asset, building as an asset, furniture an asset, and in the case of transaction 4, we have from transaction 4 we have inventory. So the balance of cash after transaction 3 from the previous slide, we have 850,000. This is the balance of cash after transaction 3. The balance of building after transaction 3 was 500,000, and the balance of furniture after transaction 3 was 150,000. In transaction 3 there was no inventory and there was no liability, but the owner's capital was 1,500,000. So during transaction 4 there was a purchase of t-shirts that cost us 300,000 in cash. So cash is paid, so we expect cash to decrease by 300,000. So the balance of cash after transaction 4 is 550,000. In transaction 4 there was no building purchased, there is no furniture, but there was inventory, that is a t-shirt that costs 300,000. So inventory is increased by 300,000 in transaction 4. So the balance of inventory after transaction 4 is 300,000. Balance after transaction 4 for owner capital is the same, 1,500,000. Here the liability is also the same, it is 0. So the total liability plus owner equity after transaction 4 is 1,500,000, whereas the total asset of the company after transaction 4 is the sum of cash plus building plus furniture plus inventory, that gives us 1,500,000. So the total asset is equal to the total liability plus owner equity after transaction 4. Now let's see, in the case of transaction 5, the company sold t-shirts for 100,000 in cash. The cost of those t-shirts was 70,000. So there are t-shirts in the company that costed 70,000, but actually the company sold them by 100,000. Inventory is decreased by 70,000. Cash is increased by 100,000, and the difference is 30,000. The difference is 30,000. This will be the revenue. Let's see. In this transaction, shirts costing 70,000 are sold for 100,000 in cash. They are supposed to cost 70,000 in inventory, but they were sold for 100,000. So their price is increased. It increases cash by 100,000 and reduces inventory by 70,000 because we sold inventory that cost us 70,000 in 100,000. 30,000 difference represents the business profit, which would be added to the capital. So since we have this profit, this revenue or this profit is the effect of this profit is to increase the capital of the company. So there are three accounts affected here. One is cash. Cash is increased by 100,000, and inventory is reduced by 70,000, and the owner's capital is increased by 30,000. So as usual, we have asset is equal to liability plus owner equity. So in the case of asset, we have four assets: the cash, the building, the furniture, and the inventory. In the liability, we don't have liability still. In the owner equity, we have Z capital, owner's capital or Z capital. Balance of cash after transaction 4 was 550,000, and the balance of furniture after transaction 4 was 150,000, and the balance of inventory after transaction 4 was 300,000, and there was no liability in transaction 4, and the Z capital or the owner's capital remains the same, 1,500,000. In transaction 5, the inventory that we registered as 70,000 is sold for 100,000. So cash is increased by 100,000 of cash after transaction 5 is 550,000 plus 100,000, 650,000. So the building remains the same. There is no change in building in transaction 5, therefore it takes 500,000. There is no change in furniture, so it remains the same, 150,000. But here the inventory is decreased by 70,000 because we already sold t-shirts that amount 70,000. So 300,000 minus 70,000 is 230,000. So 230,000 is the balance of inventory after transaction 5. The balance after transaction 5 of Z capital is 1,500,000 plus 30,000 is 1,530,000. So what will be the total asset here? After transaction 5, the total asset of the company is increased by 30,000, which is the sum of cash plus building plus furniture plus the inventory. So both are balanced. So on transaction 6, the company or Z company purchased t-shirts for 200,000 on credit. So since the purchase is on credit, there will be some account to be paid in the future. We call it account payable. This is liability account because we are going to pay this account in the future. So the account payable is increased by 200,000, and also since we purchased t-shirts, so we have inventory increased by 200,000. So the two accounts that are affected by transaction 6 are account payable and inventory. Both increased by 200,000. Account payable is a liability account and inventory is the asset account. So t-shirts costing 200,000 are purchased on credit. It increases inventory on the asset side and creates a liability of 200,000 known as account payable. Yeah, this is what I have said earlier. There will be a new liability account, that is account payable. As the name indicates, this is account that's going to be paid in the future. So this is our table. So the asset is equal to liability plus owner equity is as usual on the top. And under asset we have cash, building, furniture, inventory. But in liability we have another new account, that's account payable. And in owner equity we have only Z capital. So the balance of cash after transaction 5 was 650,000, building 500,000. Balance after transaction 5 for furniture it was 150,000. Balance after transaction 5 for inventory 230,000. And the balance of account payable after transaction 5 was 0 because there was no account payable in transaction 5. And Z capital was 1,530,000. So during transaction 6 there was no cash involved, there is no building, there is no furniture, but there was an inventory that's increased by 200,000 because we purchased t-shirts that amounts 200,000. The balance of cash after transaction 6 is 650,000. That is 650,000 plus 0 is 650,000. So here we have the building is the same, 500,000. The furniture is the same, but in the case of inventory, the balance after transaction 5 was 230,000. During transaction 6 we have 200,000 inventory added. Therefore, at the end of transaction 6 the balance of inventory becomes 430,000. And during transaction 6 there was account payable or incurred, that is 200,000. Therefore, the balance of account payable at the end of transaction 6 is 200,000. There was no change in the Z capital in transaction 6. Therefore, after transaction 6 the balance of Z capital will take 1,530,000. Here is the total asset after transaction 6. The balance of the total asset after transaction 6 is the sum of cash plus building plus furniture plus inventory, because these four are assets. So the total sum is 1,730,000. And here in the case of liability and owner equity, 200,000 liability plus 1,530,000 owner equity gives us 1,730,000. Therefore, both sides are balanced.